Welcome to the Keiser Report. I'm Max Keiser. You know, stock prices have reached what looks like a permanently high plateau. So said one of the greatest economists America has ever produced, Irving Fisher, on October 21st, 1929. 3 days later, one of the biggest stock market crashes in world history would begin. A New York Times account of the market carnage read, "It came with a speed and ferocity that left men dazed. The bottom simply fell out of the market. The streets were crammed with a mixed crowd. Agonized little speculators, sold-out traders, inquisitive individuals, and tourists seeking a closer view of the national catastrophe. Where was it going to end?" So, inquisitive individuals and financial carnage tourists out there, welcome to the Keiser Report, where we take a closer view of the international catastrophe together with Stacy.
Yes, and this is our tourist platform to view the city of London as bankers start plunging from the top of the buildings. You know, back in the Great Depression, of course, we had like 11%, 13%, 12% down days, and then 12% up days, and everybody, you know, all the warning signs, however, were there ahead of time. Not only were markets acting crazy, but at the same time, for the months leading up to it, there was a plunge in industrial production. Just like we've seen in the international markets, we've seen plunges in production in Germany, for example. We've seen oil prices acting like in a deflationary spiral. We see currencies acting like it's 2008, for example. And a lot of crazy behavior, including this first headline. Australian family adds cat to the sale of their house, increases value by £76,000. The value of an Australian family's house shot up by 140,000 Australian dollars when they agreed to include their pet cat, Tiffany, as part of the deal.
Oh, yeah, and it made me immediately think of Plucky.
That's why we brought Plucky.
Yeah, I mean, Plucky, you know, there's a cat in Australia worth 76,000 pounds, dude. You know, he's underperforming, basically.
Well, here we know that Sydney already has the highest prices.
What? Plucky, calm down.
Well, okay, markets crash, as Irving Fisher pointed out, after months and months of saying financial markets were undervalued. Finally, he capitulated and he did some genius work on debt deflation. In Australia, we see house prices continue to climb. They've been climbing. They're up 10-fold, 30-fold, 50-fold, like in years. Incomes, however, have not increased like that. Here we see the top of an already overly priced market of Sydney, where it was for 2 million Australian dollars. Then a couple comes in and says, well, we'll give you $300,000 for Plucky. These are going to be one of the moments, looking back 100 years back from in the future, looking back to today, that they'll say, well, that was a perfect indicator that market participants had lost all sense of reality.
Well, no, I found Plucky in Dublin. He had been plucked by the financial crash of the 2008 period. David McWilliams, as a matter of fact, introduced me to Plucky. He was the only one who were speaking any rational sense at that time. Plucky was, he's a friend of Michael Noonan's, who told him to go buy several properties at the top in the Irish market. And as you can see, he got plucked pretty hard. I think Noonan went on to become a bureaucrat and paid hand over fist because, of course, he's part of the Golden Circle in Ireland, which is a code for.
So as markets continue to provide so much turmoil and fun for us, of course, here on the Keiser Report, Londoners must earn £100,000 per year before they can afford a home. The NHF report, London, Broken Market, Broken Dreams, bases its calculations on workers with a 20% deposit trying to buy an average price property in their area with a mortgage of 3.5 times their salary. So what they found across London was that, in fact, you need to earn £108,500 per year in order to afford to live in London. Well, Max, the average salary in London is actually £33,000. This is, of course, just like 1929's, nobody could afford the bubble that was around them.
Well, yeah, a couple of points. First of all, back in 29, preceding the crash, you had a lot of these stock pools on Wall Street, including the likes of JP Morgan. Of course, they were involved in stock pools back in the 20s, just like they're involved in high-frequency trading or off-balance sheet accounting or stock buyback fraud activity today, and it leads to a false sense of security. Here in the UK, they claim that there's a lot more jobs in the marketplace, but if you look at the tax revenues for the country, they're down. So how can that be? It's because these are not real jobs. These are self-employed people that say, well, I'm self-employed now. I'm still not bringing any income in. But the government says, oh, that's an employed person. Or they're temporary jobs, or they're menial jobs, or below-rate jobs, or £2-an-hour jobs, as they would like to push in this country. So the point is that here, the people who are buying these $100,000 properties, the people who have produced the false statistics at the Office of National Statistics here in the UK, understand that tax revenues are unneeded. They don't need people to pay taxes in the United Kingdom because they can print money and buy houses at these overinflated prices until there's a crash. And if in fact this is the big crash we've been talking about for a number of years, it's unfolding before our eyes, yes, we do laugh about it. We do chuckle about it because it was so easy to predict 5 years ago, 4 years ago, 3 years ago, 6 months ago. And of course the BBC and other local broadcasters will say nobody saw it coming, we don't know why it happened. And it's a laugh really, because we know that it's complete chicanery, it's fraudulent accounting, it's money printing, and the results are as predictable as night follows day.
Now, the Bank of International Settlements and the IMF have warned during the course of the past year of these very exact problems, that there's a total disconnect between financial markets and the real economy. Now, back in 1929, the Fed also warned in March of 1929 that the same thing was happening. Nobody paid attention and markets continued to fly higher. It could continue to fly higher now because people, the mentality always is that the Fed will then come in. Janet Yellen will respond to the fact that it's no time to be an academic. She must buy the stocks. She must save the markets. She must print. So people will dive in as soon as it falls even 2%, which is now considered a market crash. Back then it used to be 12%, or in '87 it was 22%. Now people freak out at a 2% drop.
Well, the social contract has been broken. And according to the theory of the Enlightenment, that's a time for people to revolt, as per scholars of the time like John Locke. Now, before I forget, John Lydon, who otherwise known as Johnny Rotten, he's got a book out, as Russell Brand has a book out. And John Lydon, Johnny Rotten of the Sex Pistols, it says that Russell Brand is a I believe he called him, and nobody should listen to Russell Brand because Russell Brand is saying nobody should vote. Now, I posit that because the social contract has been broken, voting is really unneeded. You need to have a revolution. So, John Lydon, I invite you to come on the show with Russell to talk about this and sort through what's going on here. I would like to gob in his face. Back in 1978 when the Sex Pistols were in Texas, he gobbed in my face. I would like to gob in Johnny Rotten's face to return the favor as an expression of my love for punk rock. But nevertheless, they should be on the show debating this issue, revolution or no revolution, voting or don't voting.
Well, all of that stuff is, like I said about Janet Yellen, academic, or of course during Jim Cramer, during the last crash of 2008, he implored Ben Bernanke to stop acting like an academic and just save the markets, act like a punk rocker, throw all this gob.
Yeah, gobbing is the quantitative easing equivalent in punk rock. So
yeah.
Johnny Rotten is gobbing. He's, like spitting into the face of the crowd. That's the equivalent of Janet Yellen or Mark Carney printing money, and he expects the crowd to rejoice in the saliva bath that they're getting from the artist on stage, known as the Sex Pistols.
Janet Sex Pistol Yellen is pogo and gobbing. That's what it is.
Well, if Janet Yellen were to gob in the face of Jamie Dimon, I think that would be stimulating to the economy.
Now, you mentioned the stock pools and basically the manipulation and things like that led up to the 1929 crash. Well, the other remarkable story this week in Bloomberg News was this. S&P 500 companies spend 95% of profits on buybacks payouts. Companies in the S&P 500 are poised to spend $914 billion on share buybacks and dividends this year, or about 95% of their earnings, data compiled by Bloomberg and S&P Dow Jones indices show. Money returned to stock owners exceeded profits in the first quarter and may again in the third quarter. The proportion of cash flow used for repurchases has almost doubled over the last decade, while it slipped for capital investments. So companies have spent $2 trillion since 2009 in buybacks. What does this suggest? They're not putting it into capital investment. Capital investment has shrunk from over 50% down to less than 40% now.
Yeah, competition's been gutted. And when people go to the store, they see the prices of things going up. It's not because there's inflation, like wage inflation, price spiraling upwards. No, there's price gouging because there's no competition, and it's oligopolistic pricing. And so people shouldn't confuse the rising prices at the store with what you would assume to be economics would call inflation, because the backdrop of what's going on is deflation. That's because all of the banks continue to be serviced by trillions of dollars worth of bad money printing. But if you go to the store and buy stuff, your prices aren't being deflated because there's no competition out there anymore, because you've only got 2 or 3 main actors, and they're engaged in monopoly pricing, and they're price gouging. So the reason you're paying so much for these things at the store is because there's no competition anymore. It's been gutted.
But this is share buyback, so here
which
there's no
supports
competition.
a monopoly. Like Intel is a huge chip maker. They're buying back huge amounts of their own stock as a way to destroy competition in the industry, destroy any competition, to give them an enormous power to do it, to influence political processes.
Okay, but here we're talking about share buybacks. They've done $2 trillion since 2009, and as we said at the top of the show, we see oil prices collapsing. We see industrial production collapsing.
That's deflation.
And here, at the present moment, they're spending all of their earnings not on capital investment, not on the future. So not only is the past collapsing, but the future is also collapsing. So they're not investing in the future. They're not investing in a new possible industrial
GDP.
capacity.
Oil prices are collapsing because demand is shrinking, because there's no demand for oil, because the economies are collapsing due to deflation, due to the keeping alive of zombie banks by money printing, and by making it impossible for any new competitors to come along and to create some competitive environment that would increase GDP, that would increase a genuine organic growth in the economy. So you end up with the worst of both possible worlds. You have price gouging for stuff you actually buy at the store, like drugs or food. Meanwhile, the overall banking system is swirling the toilet bowl of global deflation.
Now, they also interviewed this guy, Chris Bouffard, Chief Investment Officer of a fund, and he says regarding all of this share buybacks that you see happening, you can only go so far with financial engineering before you actually have to have a business with real growth. You could say that about the UK or the US or Germany or France or Italy or Spain or Hong Kong, anywhere, or Sydney, or Australia. You know, everything has been about financial engineering. Everybody's getting in on the same game of speculation, financial speculation, wealth extraction, and nobody's doing the real job. Here he's saying, like, somebody has to prepare for the future. Somebody has to plan on doing some business. Otherwise, all of these Ponzi schemes collapse.
Financial engineering is a pseudonym for Ponzi schemes. And Ponzi schemes, you can't taper a Ponzi scheme, now it's collapsing. Okay, Stacy, we gotta go. Thanks so much for being on the Keiser Report.
Bye, Plucky. I sold you for $650,000. It's nice knowing you.
Stay tuned for the second half, my second half interview with Professor Fekete.
Very good, Plucky. You've got the job. Welcome back to the Keiser Report. I'm Max Keiser. Time now to turn to world-renowned mathematician and monetary scientist Professor Antal Fekete of New Austrian School of Economics and FeketeResearch.com. His latest paper is called Counterproductive Monetary Policy. Professor Fekete, welcome back for round 2.
Thank you very much. I'm very happy about round 2. There's a little more time to explain complicated things.
Yes, well, now, first of all, where do you come in from? Where do you live normally? Where do you hang your hat?
Well, I'm a retired professor, but it wasn't monetary science I was teaching when I was active. By the way, I retired 22 years ago, believe it or not. Anyhow, here I am, a retired professor, and I've changed my field from mathematics to monetary science, monetary economics.
Right, and as a result, you've become really a leading guru in monetary policy analysis, and also looking at the gold market. I wanted to go back in history a little bit, because back in 1913, of course, was the Federal Reserve was created in the United States, and there was an original intent of the Federal Reserve, and then it kind of changed in its mandate, and some things happened along the way, and it lost, some significant things happened, like the open market operations, etc. Can you give us a little bit, because a lot of people say, oh, 1913 was the day the world ended and the Fed was created, and it was a horrible day, but there was something that came later that was really the worst thing.
Yeah. I'm not one of those who think that the Federal Reserve Act of 1913 was altogether bad. It wasn't. It was basically a version of Adam Smith's real bills doctrine. People create money, not the central bank, and people create money by moving goods from the producer to the consumer and finance this with real bills. So this is not bad. That's the way it should be. What happened is that after the war, World War I, there was a collapse in the US Treasury bond market. Now, don't ask economists, they don't know. They are completely ignorant. This has been hushed up, but there was a fully fledged panic, and as a result, a lot of American banks saw their capital wiped out because the price of Treasury bonds collapsed. So that was in 1921. Next year, quite illegally and clandestinely, the Federal Reserve and the Treasury, US Treasury, conspired, and they introduced the policy of open market operations. But rather than being an open market operation, this was an open market purchasing plan, because on a net basis it was always adding, because that's the only way they could increase the money supply. So this was a subversion of the Federal Reserve Act of 1913.
Okay, because I know, for example, when I was working on Wall Street in 1987, there was the crash of 87. The next day, Alan Greenspan, Ronald Reagan, and Robert Rubin, who's the Treasury Secretary, got together and they started buying S&P futures contracts, stock market futures, in the open market on behalf of the Treasury, on behalf of the Federal Reserve Bank. And a lot of people were saying, wow, you know, this is the end of free market capitalism as we know it, because the government is now become a hedge fund.
That's right.
But what you're saying is going back to 1921 was really the genesis of when the Fed completely eliminated its mandate to be kind of the lender of last resort, if you will, or an intermediary for the commerce of the day, and becoming more of an active player on a day-to-day basis in support of the bond market, which was under stress.
And this was illegal. It was against the law as it stood then. It took until 1935 before they amended retroactively the Federal Reserve Act of 1913 to allow for this. But
well, let me jump in here for a second, because it reminds me of the crisis going back, leading up to the 2008 crisis. I remember when Citigroup and Travelers Corp, the insurance company, they merged in creating this global supermarket. It was completely against Glass-Steagall, a law from the crash and the Depression. But Sandy Weil, at the time, who was leading this conglomerate, led it anyway, and they retroactively went and they said, well, we're going to change the law retroactively to make this legal.
Yeah.
You know,
the same idea. Laws should not be retroactively changed. If you change the law, it should apply to the future. If you make it to apply back to, this is always bad and creates bad blood and creates and looses up any kind of morale in the market.
Yes, but let's look at this. You know, the bankers are always saying that as financial engineers, they are inventing things, and that the law hasn't caught up to them yet. That they're so smart, they're so brilliant. They create derivatives. They created a credit default swap. They create a collateralized mortgage obligation. And technically, these things would violate laws that are in place. But they say that they need to break the law to expand the economy. Is that right?
That's right, but it's not. It's not helpful to the economy, because this is like kicking the garbage upstairs to the attic. There's a limit after which the garbage will come crashing down, and that is what is happening. And what you will see is a complete collapse of the bond market.
In the sovereign bond market, it seems to be the most vulnerable because, and I just noticed that Finland lost its AAA credit. And Finland was one of the very few remaining AAA credits in the world. And of course, these AAA bonds, whether it's Finnish sovereign debt are used as the collateral for on the pyramid, the base of the Ponzi scheme pyramid.
That's
so
right.
If the collateral is deteriorating and there is no AAA credit, and they have to keep adding more debt, like a Bernie Madoff, so sovereign debt itself, the gilt, the U.S. Treasury market, and other sovereign debt could go the way of subprime lending or the dot-com bubble. It's a bubble. Is it a bubble?
Yes. Well, bubble is just another word. I don't use that word, but I don't object other people using it. What happens is that the quality is going down, and this can be ignored because only the quantity of money, trying to jack up the quantity of money, hoping that this will prevent deflation, meaning commodity prices. But the central banks don't control how people spend the money. They can print as much as they want, but they cannot control how people. So if the bond speculator simply preempts the Fed, then that means the money is not flowing to the commodity market, it's flowing to the bond market. And that means higher bond prices, lower interest rates, and that spells deflation and ultimately depression.
Now, Professor Fekete, since you've been on the Keiser Report a couple of times, it seems as though your message is getting through because the IMF just said recently that these 0% borrowing costs are just aiding speculation and they're doing nothing to increase capital spending or investment of any kind.
But I have been saying that for 8 years.
Why are they so slow to pick up on these facts?
Well, I don't know whether they read my book. If they read it, well...
But they validated what you've been saying, that their expansionary policies meant to create or to fight deflation have actually caused deflation.
Well, that's what I'm saying. And they don't use the same words, but the effect is the same because it's not working. They are pumping money into the economy, but the money is not doing what they want to do. They say, oh, pray to goodness, the money should flow to the commodity market. It's not. And what I tell you, what is more, is the bond speculators, whatever money they had in the commodity market, they redeployed in the bond market because the profits in the bond market are risk-free and profits in the commodity market are not risk-free. So why should they take the money to the casino?
Yeah. Well, there's the concept in economics is called moral hazard. You are rewarding the bad actors.
That's right.
You are rewarding the crooks.
Yeah.
And you are saying, you're putting up a big green light and saying, we want you to be more crooked because the whole economy is based on you being increasingly more crooked. But let me ask you this, in terms of weeding out the bad actors, getting rid of the crooks, there's two ways to do it. You can go down to the city of London or Wall Street, you round them up, you take them into prison, and you throw away the key. That's one way. Mm-hmm. Another way, using the tools of monetary policy and economics, it would seem that the only way to get rid of the worst actors in this scenario would be to raise interest rates. Mm. Now, if you raise interest rates, you increase the cost of speculation, and the most leveraged amongst us, who are doing the most speculation, get not decapitated, but decapitalized. Now, wouldn't that be somewhat counterintuitively, but can't you create inflation by raising rates, getting rid of the crooks, and opening the economy to real competition and real growth?
Well, raising interest rates is very, very risky because what this means is that the bond values will...
But you're saying that they're going to crash anyway because these policies aren't working. So why not get proactive? Isn't the policy of the central bank to be proactively engaged in managing the economy? Why are they waiting for this sovereign debt crash to wipe out a whole generation? Why can't they, like Paul Volcker did in the 1970s, to get rid of inflation, to get rid of or to rebalance the economy? He raised rates.
well, he was in a much stronger position. The US government was in a much stronger financial position. And, but now, there is a danger that actually commodity prices are going to fall. Let me tell you that the price formation has so much supply and demand, but it also has so much speculation. If the speculators, commodity speculators, do not support the action of the Fed, then there's not going to be price increases.
Okay, we have to cut it there. Professor Fekete, thanks for staying with us for another episode of the Keiser Report.
Thank you very much.
All right, well, that's going to do it for this edition of the Keiser Report with me, Max Keiser, and Stacy Herbert. I'd like to thank our guest, Professor Fekete of FeketeResearch.com. If you'd like to contact us, you can tweet us at Keiser Report. Until next time, bye, y'all.